David, tell us a little bit about perhaps the demand destruction that we might see for Asian goods and where you could see the biggest market impact when it comes to what's happening in Ukraine.
Well, I think that American consumers and also European and British consumers are already dealing with elevated prices in goods and services. And certainly if the price of oil continues to go up, and that will certainly affect consumer sentiment when they're pumping gas in their cars. And I think that that would certainly have an impact in terms of how American households think about spending their money. So I think that either potentially on goods and services, and especially goods coming over from Asia.
When it comes to some of the costs of this war in Ukraine, what are your thoughts on the cost to the U.S., especially when it comes to the credibility of the dollar now that we're seeing all of these sanctions, and perhaps the idea that reserves held in the U.S. might be subject to political risk?
I think it's certainly a wake-up call to many other central banks around the world that are watching this and have been surprised that there are sanctions on the Russian central bank in terms of the reserves being frozen abroad. And I think that perhaps this may shake a bit of confidence in the U.S. dollar, or at least storing wealth and reserves in U.S. dollar. And perhaps central banks and citizens around the world that are watching this may think about diversifying into other forms of currencies or sources of wealth.
If you haven't diversified at this point, is it a little bit late? What sort of hedges would you be looking at right now?
I think that what we're seeing both from the Russian central bank as they diversify into the cryptocurrency, gold, and also the RMB, I think that these are also great diversifiers for investors as well.
What about China as a diversifier? Because there's certainly a group of investors that look at it almost with haven status at the moment.
I think that China could potentially come out of this as the net winner, both in terms of the ability to conduct business with Russian entities, and also purchasing Russian natural gas and oil, but also as there potentially is a geopolitical line for China to play, both in terms of collaborating or working with Russia from a commercial side, but also being able to trade and engage with the West. So I think that China is certainly in an interesting position as of this point.
Let's talk a little bit about the rotation that we're seeing, because we had all of this momentum for value, but that seems to be disappearing, and people seem to be crowding growth stocks again. Is this now the new normal given the uncertainty out there?
I think that there's going to be a bit of seesaw action right now, a lot of market volatility as to what the Fed is going to do in response to the geopolitical tensions, whether we're going to see a 50 basis point hike in March or a 25 basis point. And I think a lot of that is motivating investors as to whether they're going to continue to pivot or rotate from growth and tech over to value and to cyclicals. I think that rotation is currently being delayed as investors try to figure out how long this war is going to last and what that means for monetary policy in the U.S.
What does it mean for the consumers as well, from an inflation and and spending and confidence standpoint, right? Particularly as we see kind of just a nascent start of the reopening post-pandemic in a lot of economies.
That's what I'm worried about in terms of if oil and energy prices continue to go up, that this could potentially be a very damaging influence and factor on consumer sentiment and consumer spending. And then we have continued elevated prices. So I think that if there's going to be any kind of stagflationary risks or shocks, I think that could potentially come later this year.